Now that you understand accounting basics and principles, it's time to apply them in QuickBooks. The focus of this chapter is the financial statements and the chart of accounts. Let's talk about the relationship between these two items. Remember, you use accounts from the chart of accounts to classify or label transactions. Every transaction you enter into QuickBooks uses accounts, which means the transaction affects the chart of accounts. The chart of accounts is truly the end result of your accounting. So, if you want to know how your business is doing, look at the chart of accounts. To do this, accountants develop two financial statements that summarize the chart of accounts: the balance sheet and the profit and loss statement. Each line in the chart of accounts becomes a line on one of these two basic financial statements. In fact, the chart of accounts and financial statements show the same information. However, the financial statements are in a report format that's easier to read and use. The point: to prepare accurate financial statements, you must set up the chart of accounts correctly. You learn to do this during this chapter. First, though, you learn how to run the two financial statements, the balance sheet and the profit and loss statement. Then, you review the major sections of each financial statement.
Let's talk about the balance sheet. Click the Reports menu and select Company and Financial, Balance Sheet Standard. The balance sheet is a financial snapshot of your business at one moment in time. Think of someone taking a giant Polaroid camera and snapping a financial picture of your business right now. That would be your balance sheet. Let's look at the elements of the balance sheet. The first section is called Assets. Assets are all the stuff the business owns. Notice the balance for checking, accounts receivable, and inventory. This is all stuff the company owns. Scrolling down, you see that Build'em has total assets of about $155,000. The next section on the balance sheet shows liabilities. Liabilities are what the company owes to others. For example, Build'em has some accounts payable, sales tax payable, and a loan from the bank. Build'em has total liabilities of about $78,000. The last component of a balance sheet is equity. Equity is what your business is really worth to the owner. For example, let's say you sell this company today. The total assets are on the books for $155,000. You receive a check for the $155,000 and deposit it in your personal bank account. Then you need to pay the liabilities of the business. From the original $155,000, you pay liabilities of $78,000. What's left in your account after you pay those liabilities is called equity. For Build'em, equity equals about $77,000. In other words, you would owe the owners or shareholders about $77,000. Remember, this is the accounting equation you learned earlier. Total assets of $155,000 equals total liabilities of $78,000 plus total equity of $77,000. In the next topic, you learn more about the profit and loss statement. Let's talk about the second financial statement, the profit and loss statement. Choose Reports, Company and Financial, Profit and Loss Standard. This report shows just this month's activity. Click the Dates drop-down arrow and change the date range to this fiscal year to date. During the last topic, you learned that the balance sheet is like a financial photograph of your business. Consider the profit and loss statement to be more like a financial movie for your company because it shows how you did over a period of time, just like a movie. The profit and loss statement has three major sections. The first is income. Income is the money coming into the company. For Build'em, income accounts include part sales and service income. The second section is cost of goods sold. Cost of goods sold is the cost of the products you sell or the cost of providing your services, like construction labor and materials. Some companies do not have a section called cost of goods sold. Total income minus total cost of goods sold equals gross profit. That means your profit before accounting for overhead or operating expenses. The last section is called expense. Expenses represent other costs paid by the company, such as advertising and bank service charges. Accountants often refer to this section as overhead or operating expenses. Remember, consider the profit and loss statement as the movie of your business. The most important part of a movie is usually the ending. If it is a great ending, that is what you remember. If it is a bad ending, that is what you remember. The profit and loss movie also has an ending. It's called the bottom line. It shows whether you made money or not. This financial movie has a happy ending. Net income of about $15,000. How does QuickBooks calculate the net income? The math is simple. Take the total income, subtract total cost of goods sold, and, scrolling down, subtract total expense, and voila, you have the bottom line. Let's close the profit and loss statement. Then click the Chart of Accounts icon on the home page to open the Chart of Accounts. Remember, each line in the Chart of Accounts becomes a line on one of the two financial statements. That means your Chart of Accounts must be set up properly to get accurate financial statements.
Now you learn about account types. Remember, the Chart of Accounts and financial statements show the same information. The financial statements are in a report format that's easier to read and use. Here's an important point. An account only appears on one of the two financial statements, and it appears in a specific place on that financial statement. How does QuickBooks know which financial statement to put the account on and at which specific place it should appear? By using account types. The account type tells QuickBooks which financial statement and where on that financial statement to place the account. For example, a bank type account appears on the balance sheet under the checking savings heading. Income accounts appear on the profit and loss statement under the income heading. What if the account type is wrong? This means that the account will appear in the wrong place on the financial statement and your financial statements will be wrong. The account type also determines how QuickBooks uses the account. For instance, suppose you want to write checks. When you set up the account, you must select bank as the type. It's vital that you use the correct account types. Next, you learn the correct account types to use. However, if you're still unsure about which account type to use, consult your accountant. Then you learn to add an account for a new computer, and you learn when to enter the account type.
You must select the correct account type to ensure your financial statements are correct. First, you learn about the account types that appear on the balance sheet. Let's review why you need to select the right account type. Remember, the account type determines which financial statement the account appears on: the balance sheet or the profit and loss statement. This must be correct or your financial statements will be wrong. When you add an account in QuickBooks, first choose the right type. The highlighted account types appear on the balance sheet. These account types appear on the profit and loss statement. In this topic, you learn about accounts that appear on the balance sheet. The first is a bank type. It tracks your company's cash and includes checking and savings accounts. Bank accounts are assets, so they appear in the Assets section of the balance sheet. The next type is accounts receivable. It tracks how much customers owe you. Accounts receivable is also an asset, so they appear in the Assets section of the balance sheet. The third type of account is Other Current Asset. These are assets you intend to convert into cash within 1 year. Examples include inventory and short-term investments. These accounts appear in the Assets section of the balance sheet. The next type is called Fixed Asset. These are assets you don't intend to convert into cash within 1 year. Fixed assets might include furniture, fixtures, and computer equipment. QuickBooks also shows fixed assets in the Assets section of the balance sheet. The fifth type of account is Other Assets. These are assets that do not fit into one of the other asset types. An example of an other asset is a long-term investment. Other assets also appear in the Assets section of the balance sheet. The account types you've seen so far in this topic show what the company owns, the assets. Now let's focus on account types that show what the company owes, the liabilities. Accounts payable is the first of these account types. This type tracks money the business owes to others. Accounts payable appears on the balance sheet in the liability section. The next account type is credit card. Use this account type for credit cards you use for business expenditures, such as American Express or Visa. Credit card accounts appear in the liability section of the balance sheet. The next type is Other Current Liabilities. These are liabilities you intend to pay within a year, but are not credit cards or accounts payable. Examples include sales taxes and payroll taxes the company owes. Other current liability accounts appear in the liability section of the balance sheet. The next type is long-term liability. These are liabilities your company will not have to pay within 1 year. Examples include a mortgage payable and long-term loans. Long-term liability accounts appear in the liability section of the balance sheet. The last type of balance sheet account is equity. Remember, equity accounts show what the business is worth to the owner. You can also think of equity accounts as what the company owes the owner before paying any applicable taxes. For example, money invested in the company by the owner could be an equity type account called owner's contribution. Another example is retained earnings, which you learn about later in this training. Equity accounts appear in the equity section of the balance sheet. You must choose the correct account type to produce accurate financial statements. You've learned about account types that appear on the balance sheet. Now you learn about the account types that appear on the profit and loss statement. The first type is income. Use income accounts to track sources of revenue, such as part sales and service income. Income accounts appear in the income section of the profit and loss statement. The next type of account is cost of goods sold. Remember, these costs are directly associated with what you sell. These accounts appear in the cost of goods sold section of the profit and loss statement. Expense is the next type. These track operating expenses other than cost of goods sold. Expenses are sometimes called overhead or operating expenses. Examples include office supplies and rent. Expense accounts appear in the expense section of the profit and loss statement. There are two more profit and loss account types that you don't use very often. The first is other income. Use this type of account to track non-operating revenue. This means money you earn doing something different than your regular business, such as interest earned on money in your bank account. These accounts appear in the Other Income and Expense section of the profit and loss statement. Other expense is the last account type. Use this type to track non-operating expenses. This means expenses not usually associated with your business. An example could be late fees, unless paying late fees is part of your normal operating procedures. Other expense accounts appear under the Other Income and Expense section of the profit and loss statement. Remember, selecting the correct account type is critical. If you're not sure what account type to choose, ask your accountant. You've learned definitions and examples of all the account types. You set up an account in the next topic. Bildum just purchased a new computer for $2,000. Click the Chart of Accounts icon. Click the Account button in the lower left-hand corner of the window. Then select New from the menu. Select the appropriate type of account. Computer is the fixed asset type. QuickBooks provides a description of fixed assets to the right. Click the Continue button. Enter the name of the account, computer equipment. The description and note fields and the Enter Opening Balance button are optional. Let's leave them blank in this example. When finished, click Save and Close. Now the new account is included in the chart of accounts. Does the new account appear on the balance sheet? Let's have a look. Choose Reports, Company and Financial, Balance Sheet Standard. Computer equipment does not appear on the report. Why? Accounts with zero balances do not show on the balance sheet. Let's write a check to purchase the computer. Choose Banking, Write Checks. Click the Payee drop-down arrow and select Computer Warehouse. The computer costs $2,000. Now enter the appropriate account. Click the Account drop-down arrow and select the new computer equipment account. Click Save and Close to record the check. Now the computer equipment account appears on the balance sheet. Close the balance sheet. You also see this balance on the chart of accounts.
How many accounts should you have on your chart of accounts? In general, keep the chart of accounts as short and simple as possible. Why? As you've learned, the accounts become lines on your financial statements. If the chart of accounts is long, the financial statements will be long and more difficult to read and use. Imagine how tough it would be to monitor expenses on the profit and loss statement if there were over 1,000 different expense accounts. So, what accounts do you need? The reporting principle, which you already learned about, provides some guidance. This principle states that financial reports must show information that is useful to a user. Let's apply this principle to the real world. Take insurance as an example. This is a significant cost to businesses, and you should track the cost in a separate account. Let's take this further. Assume you have different types of insurance: liability, health, and workers' comp. These are significant costs that you need to manage. So, you need to see them on the financial statements. In other words, what you spend on different types of insurance is useful to users of the financial statements. This means that you set up accounts for each type of insurance. But here's another problem. The insurance accounts are scattered through the expenses section of the profit and loss statement. To see the total insurance cost, you need to grab your calculator, find the different insurance accounts on the report, and do the math yourself. QuickBooks has a much easier way to do this, called sub-accounts. Sub-accounts allow you to group similar accounts together on financial statements, and QuickBooks shows a subtotal for the accounts. You create one account called the parent, which would be insurance in this example. Then you create sub-accounts for the specific types of insurance: liability, health, and workers' comp. Next, you learn more about sub-accounts. Then you add a sub-account. Finally, you use sub-accounts to change the level of detail QuickBooks displays on your financial statements.
Click the Chart of Accounts icon. When you look at the chart of accounts, the accounts to the left are parent accounts, and the accounts indented and below the parent accounts are sub-accounts. Scroll down to see another example. Insurance is the parent account, and property insurance and workers' comp are sub-accounts. What are sub-accounts? They allow you to track finances in more detail by grouping related accounts and showing a subtotal for those accounts. Let's look at this on a profit and loss statement. Choose Reports, Company and Financial, Profit and Loss Standard. Click the Dates drop-down arrow and select this fiscal year to date. Scroll down the report. Here are the insurance accounts. QuickBooks groups the sub-accounts together on the report and calculates a subtotal for insurance. What sub-accounts do you need in the real world? Whatever accounts are necessary to manage your business more effectively. For example, Cleaning costs are $320 this year. Do you need more detail about cleaning on your financial statement? Do you need to know how much it costs to clean the office versus the restroom? No. $1 amount for cleaning is enough information. Insurance is different. This can be a significant cost in certain industries. In this case, Buildem needs to track exactly how much money you spend on each type of insurance. Use sub-accounts to track this information. You can have multiple levels of sub-accounts. Let's scroll down to look at an example. You can track utilities such as electricity, gas, telephone, and water. Telephone costs are tracked in even more detail: fax, local, and long distance. QuickBooks supports up to 5 levels of accounts, a parent account, and 4 levels of sub-accounts. So, you could set up a sub-account of a sub-account of a sub-account of a sub-account of an account. You need to account for the computer's cost and accumulated depreciation. In this topic, you set up the sub-accounts to track cost and accumulated depreciation. Click the Account button and select New from the menu. This is a fixed asset account. Click Continue. Type the name of the account, Accumulated Depreciation. Click the box next to Sub-account of. In the next field, enter the parent account for this sub-account. Click the drop-down list and select Computer Equipment. The description, note, and opening balance are optional. Click Save and New to create a sub-account for cost. QuickBooks assumes this sub-account is a fixed asset. Type the name of the account, Cost. Click the box next to Sub-account of. In the next field, enter the parent account for this sub-account. Click the drop-down list and select Computer Equipment. Click Save and Close. The new sub-accounts, Accumulated Depreciation, and Cost. In the next topic, you learn to collapse financial statements. Let's look at the reporting benefits of sub-accounts. Click the Reports menu and select Company and Financial, Profit and Loss Standard. Click the Dates drop-down list and select this fiscal year to date. Let's scroll down to look at Utilities. QuickBooks automatically shows all the sub-accounts on the profit and loss statement. There are many instances where you do not need this detail. For example, if you apply for a loan, the banker does not need to see the detail for electricity, gas, or telephone. They do need to see utilities in total. If you are only interested in the general categories, click the Collapse button, and QuickBooks hides the sub-accounts. Now utilities appear as one line. To see the detail again, click the Expand button. Scroll down again to see the individual sub-accounts. In the next topic, you get even more information from financial statements.
Remember, the balance sheet shows the value of the business's assets and how much the business owes and how much the business is worth to the owners. The profit and loss statement summarizes the business's performance over a period of time. These financial statements show a balance as of the report date. That balance is really a summary of transactions that affect each account. What if you want to see the specific transactions that make up the balance shown on the financial statement? For example, you run a balance sheet and the amount in the checking account doesn't look right. How can you see the transactions that make up that amount? In the next few topics, you learn 3 ways to do this. 1, use an account register for the specific account. 2, run a quick report for the account. And 3, use QuickZoom directly on the financial statement. You learn another method, running a general ledger, later in this training.
You can open account registers from the Chart of Accounts. First, click the Chart of Accounts icon. When you look at this list, QuickBooks lists the balance sheet type accounts first. These types of accounts have balances to the right. These balances are calculated based on every transaction that has affected the account. QuickBooks shows these transactions in the account register. Double-click the checking account to display its register. The register displays every transaction associated with this account. Remember the discussion of source and use earlier? If a number appears in the payment column of the check register, then the checking account was the source of the money. In this case, the source of the $200 is the checking account, and the use was telephone expense. QuickBooks also displays the date of the transaction and who was involved, Dallas Bell. Remember, this is important for record keeping. By default, QuickBooks displays transactions in chronological order. To see earlier transactions, scroll up in the register. An amount in the deposit column means the checking account is the use, or where the money went. This $32,700 went to the checking account. The account field indicates the source, or where the money came from. In this case, undeposited funds. You learn about undeposited funds later in the training. Only balance sheet accounts have registers. In the next topic, you see the transactions that affect profit and loss accounts. Scroll down the chart of accounts. QuickBooks lists profit and loss type accounts below the balance sheet accounts. Notice that these accounts do not have balances listed to the right. Profit and loss type accounts do not have registers listing every transaction. So how do you see the transactions affecting these accounts? Double-click Freight Income. Instead, QuickBooks displays an Account Quick Report for profit and loss accounts. By default, Account Quick Reports list all transactions affecting profit and loss accounts for this fiscal year to date. Click the Dates drop-down list to change the period. Account Quick Reports also display the date and who was involved in the transaction. Remember, this is a key component of accounting, the record-keeping component. Use Account Quick Reports to view transactions that affect profit and loss accounts. You can view the underlying transactions that make up account totals on financial statements using the Quick Zoom feature. Suppose you generate a profit and loss for this month to date. Click the Reports menu and select Company and Financial, Profit and Loss Standard. Notice that construction income is negative. That's bad. To identify why the income is negative, place the cursor over the number and it becomes a magnifying glass. This means you can zoom in to see the underlying transactions. Double-click the left mouse button, and the Transaction Detail by Account report lists the transactions that make up the amount. This transaction seems wrong. Let's zoom in again to find out why. Double-click on the negative amount, and QuickBooks displays the transaction. In this case, it's an inventory adjustment, but the adjustment account is construction income. That's a mistake. It should be the spoilage account. To fix this mistake, click the drop-down list and select Spoilage. Click Save and Close. Close the Transaction Detail report. Now the construction income balance looks correct. The Quick Zoom cursor is a magnifying glass that gives you a more detailed view of report data.